Do you know what bad habit investors can't get out of? This is John Kumarianos, founder of Mindful Advisory, and we're going to talk about that habit in this edition of Capital Considered. The bad habit is owning a ton of company stock in your 401k. Companies, unfortunately, sometimes make it attractive for you to own the company stock in your 401k, in addition to having access to other funds like index funds. And people think they're doing themselves a favor when they own a lot of the company stock, but they're often not. There can be catastrophic consequences to that if the company begins to have trouble. We saw that with Enron. The beginning of the 2000s, Enron turned out to be a fraudulent company. At its peak, it was the sixth largest company in the country. So it was a company of some consequence. And a lot of employees got wiped out, not just because the company went bankrupt, but because they lost all their savings, which they had in the company's stock. So on Monday of this week, IBM went from 290 to under 220. Today on Friday, as we record, it's around 213 per share. That's a loss of about 26%. Brett Aarons at MarketWatch estimates that $400 billion was lost by employees who own the stock in their 401k plans. There's a lot more money in IBM's 401k plan than $400 million. But that's still a significant loss that was needless. I think investors and employees delude themselves sometimes. You work at a company, you think you know the company. You have also some affection for or attraction to the company because the company hired you. The company took a chance on you. And if the company's offering you stock and you like it and you delude yourself into thinking you know that it's doing well, you're going to be inclined to buy the stock. But don't fall for that. Your mind is playing tricks on you. You don't know how the company works necessarily just because you work there. You don't know how healthy it is just because you work there. In Brett Aarons' article, he quoted an advisor, and all of us in the advisory business see investors and clients who do this. They overweight their 401k to company stock. And so he quoted an advisor saying, it's double financial jeopardy. If the company goes bankrupt, just as Enron did, you not only lose your job, but you lose whatever you've saved over the course of your career there. And so that's a kind of double hit that you take. Too much is riding on one company when you're both employed there and your 401k is stuffed with the company's stock. You're not diversified enough. So everyone should sort of cool it with owning company stock in their 401k plans. Last on this psychological issue of being attached to the company and having some affection for the company because they hired you, don't ask yourself if you believe in the company. Ask yourself what would happen if the company struggled or, in the worst case, went out of business. What would that mean for you? That's what you should ask yourself, not, do I believe in this company? Be a little more cold about it. Yes, the company hired you. Yes, I understand that you have some affection for the company, but don't put all your eggs in one basket for that reason. Don't let your affection for the company or your attachment to the company get in the way of prudent investing. And having a ton of company stock in your 401k is not prudent investing. Okay, that's the news for this week. IBM stock takes a dive, but learn a lesson from it. This is John Kumarianos for Capital Considered, signing off. Thank you for watching.
No information on this podcast should be construed as investment, tax, or legal advice. This podcast is not an offer for advisory services or to buy or sell securities. Before making any financial decisions, consult with a qualified professional advisor who can assess your individual needs and circumstances. Past performance is not indicative of future results, and all investments carry risks, including the potential loss of principal. Securities discussed in this podcast may be holdings of the host or his clients.